Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? That basically you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. All right, hi everyone. I'm Mason Clement, host of a Scalable Real Estate Investing Podcast, and today we have Johnny Wolff with us, who is the founder of HomeRoom, which is found at livehomeroom.com. And thought I'd have him on the show. Seems pretty interesting to talk about. I believe co-sharing living spaces, I guess renting out your living room, leasing your room, stuff like that. So Johnny, let's jump into things. What's going on?
How's it going, Mason? Good to be here, man. I'm excited to talk to you and your listeners.
Perfect. So yeah, like I was saying before we started recording, I like to have every guest talk about their journey and background and what brought them up to today. So let's just start with that.
So I, began investing in real estate. I bought my first rental in oil country, Texas, where Friday Night Lights is based out of Midland. A year out of college. It was back in the day when you could do 10% down loans, which was pretty sweet. And so I bought a number of other properties remotely, was working in San Francisco till about 2015, and really liked real estate, and did some financial modeling on how my returns would be if I put my money in my company stock and technology or invest in real estate. And the numbers were pretty clear that real estate was a more powerful model. And so I moved to Austin, Texas in 2015 and to invest in real estate full time. Picked up, 7 figures of properties, single family homes throughout the area, and rented them out by the room to increase rents. And renting out by the room is interesting. It's challenging, but you do get more rent. So the returns are better. So it seemed to work really well. And friends heard what I was doing and they wanted to invest how I was investing. So it inspired me to start HomeRoom in 2018. Today, we are in 10 metros in the United States. We've housed thousands of roommates. We have a few million in assets under management on the platform. In addition to that, we received some VC funding, seed round, as well as going through the Y Combinator class in 2022. So HomeRoom's, So it's been quite a ride since 2018 when we started it.
Okay. So when you were starting out renting these like by the room, were you just doing it on Airbnb and Vrbo, or how were you doing that?
Craigslist primarily.
Okay, cool. So I think the first thing that people are probably going to ask is, how does your company differ from Airbnb? And also, I feel like Airbnb recently had started promoting this concept of renting out rooms, co-living, stuff like this. It's kind of this burgeoning niche or space. Could you just talk about stuff like that?
Yeah. Well, short Airbnb or short STR, short-term rentals, is different in the fact that it's short term, right? So it's those have big technology platforms that drive the pricing, pretty big technology suites around demand and how to optimize properties. There's a lot of the ecosystem's pretty well developed, I guess, on that side, and it targets by night. The co-living ecosystem is way less developed. There's players like us, Pad Split, Bungalow, that are doing it, but we've started to build out some of the technology ecosystem that we see with Airbnb and short-term rentals, but it's long term and it's by the room. So pricing models are still in development. So it's a much earlier stage product. It's a longer stay. It's less variable. We don't have seasonal spikes and dips like short-term rentals. And um, so I think the short-term rental upside's a bit more, but the stability of co-living is certainly better.
Okay. And are people usually asked to sign, I guess maybe instead of me just putting words in your mouth, what term are people usually agreeing to when they sign up for living in a room? For in terms of
Uh,
time, the months.
yeah, I mean, the average lease, the most standard lease is 1 year. We do as short as 3 months, although you're gonna have to pay a considerable premium to do that.
Okay. And when you had moved over to Austin, I'm just curious how you went about financing the acquisition of the like seven figures in properties.
Yeah, primary residence loans. Primarily, I did some owner financing. Basically, all the low out of pocket like scheming. I bought an owner finance deal. Did primary residence loans on a couple, and one of my early exits from Midlands, I turned into a down payment on another one. So buying seven figures in properties in Austin looks like, at the time, like five properties. So it's not as impressive as it sounds.
Yeah, it sounds very nice, but I mean, imagine
Yeah.
now it's probably even less properties because the values have only gone up,
Yeah,
right?
probably two. Yeah.
Okay. Yeah, depending on what size, yeah. Actually, when I moved back to Texas from New York, I was looking at Dallas and Austin, and even back then in 2019, prices were considerably different for like a three bed, two bath house. So
Yeah.
now it's
It's it's
yeah.
it's climbed it's really climbed over the last. Yeah, at COVID it went it of all the crazy markets, Phoenix and Austin went bonkers and they both pulled back pretty heavily because it's like everyone in the world wanted Austin real estate, which I still think, just like any hot asset, I think I guess I'd make crypto an exception. I don't really know if I think that's a hot asset, but like a lot of times when stuff has a big run up, you have to look like, is it like, are we looking at Beanie Babies where there's like no value? And like, are we looking at something that actually has a lot of value and then just got too much excitement over it? Right. And I think that's how I look at Austin and kind of Phoenix. It's like the sentiment, the underlying ecosystem of the city is still really great. It's just everyone got real bored and put all their attention in like a couple markets and it drove the prices, way beyond reason. So yeah.
Yeah, that makes a lot of sense. So are you based there still and your company's based there in Austin?
Yeah, we're KC based. I moved to Kansas City in 2018. When I started the company, it was focused in Kansas City exclusively. We're in all the major Texas markets now as well. Austin, San Antonio, and Dallas. Uh, and we're starting in Houston. We're also in Indianapolis and Atlanta, and looking at Florida pretty closely as well. So,
Okay. Are you from Texas originally?
from California.
Oh, okay, got it. I just was curious on the focus of on Texas markets, like starting with Midland. Was there any reason for that?
I like paying property taxes. So
Okay.
no, not really. Texas, I think like, real estate is, I think, a cool fusion of a bond and a stock, right? You get the bond is sort of the recurring cash flow you're going to make uh from the property. And just like a bond, like the riskier it is, the more, the higher you're going to get paid, but then you're going to have more risk, right? You may lose, you may not get your coupon, you may not get your paid out. But there's also the stock component, um, which is the stock component is like how good of a market you're in and how big the economy is growing. And we look at those economies with a few lenses. We look at it at like the nationwide level, we look at it at the statewide level, and we look at it by the city and metro and zip code. And so Texas has always been the economy that I, at least to this point in my career, has been the economy that I've liked the most. Never really liked the property taxes, which is a bummer, but from like a appreciation standpoint, it's worked out very well. At this point, I think it's still really, really strong bet. At some point, Texas will reach its end and it will kind of appreciate to the point where the prices are at parity with parts of California. And then then I think it won't have as much room to grow. But for now, I think it's a really strong option.
Okay. Yeah, and I guess it depends on which zip code, which neighborhood you're buying in too. So I remember even while I was still living in New York, looking at like downtown condos in Austin, and the price was pretty similar to apartment I'd buy in New York, like starting at half a million and
Yeah.
up. But these are like brand new builds and makes sense, like luxury in the middle of downtown.
Yeah. Wait, what year was that?
2019.
Yeah. Yeah. Those new builds in downtown Austin are pricey. They definitely get more than half a mil. Yeah.
Yeah, yeah.
But I
Well,
mean,
half a mil is pretty cheap
you can
now.
walk. Yeah. Yeah. It's pretty cheap now. I should have bought a condo and I live there. Stupid. But, yeah, I mean, you got to walk to the coolest bar scene in the entire country, right? So it's pretty sweet. To buy a condo in the coolest bar scene in New York is going to cost you, quite a bit more. So,
Yeah, definitely. Unless like for a time I was living in Chinatown, I was paying like $500 a month in rent, and you had to be very open-minded and creative when you're doing stuff like that. It was tremendously cheap and awesome for a kid in his early 20s, but now having my own son and a wife, it's not quite as practical. So, but yeah,
yeah, I mean, it makes it hard. I mean, I guess, yeah, and they're probably not going to want to live in Chinatown with you, unfortunately.
yeah. Although my wife is from Hong Kong, from China, she doesn't
So,
necessarily like the idea of living in a shoebox in Chinatown.
yeah, I think maybe not Chinatown specifically. It's more in a room in Chinatown for $500, probably off the
Yeah,
table.
with a
Yeah.
shared bathroom and kitchen and fortune tellers next to you and stuff. It was pretty fun. But anyway, going off on a tangent. I actually went to UT though. I don't know if you know. Went to UT Austin. So
Oh,
UT alum. Yeah.
cool,
So
man.
very familiar with it. Actually,
You guys are pretty good these days.
oh yeah, it's been picking up. So like when I was there, we had Colt McCoy, and he was like, he brought us to the BCS Bowl. I don't even know if they call it. I don't think they call it the BCS Bowl anymore. But we played. I think it was Alabama. This was like in 2010 or 2009. I forget. Lose track of the time. And I think maybe it was 2008 or nine. And then he got injured, so we got second in that. So got like second nationally, and that was kind of the peak. And then I think his brother Case McCoy took over, and it was kind of just downhill from there for the next 10 years or
Yeah,
so. Finally getting better.
right.
And Sam Ellinger was really good recently. He's not around,
Yeah.
obviously, but this other guy is doing pretty well. So gone
I
through
saw
plenty of
Sam.
coaches.
I actually saw Sam play like I think his first game. Is that right? Yeah, I think so.
Nice.
Yeah, because I went down there to visit some friends. He was good. And you guys, yeah, it's a super fun city though. So it gives me continued confidence in like the Austin market in terms of long-term investment opportunities.
Definitely, yeah. Yeah, I've lived in a number of places in the world, and Austin's one of the definitely very unique ones, and that's why I still keep my Austin phone number. I feel like it's going to be the next 212 area code, 512, and maybe eventually at a high demand, I could sell it for $1 million or something. I don't know. We'll see.
Maybe, man. Maybe that's the key is flipping area code phone numbers. I wish you luck on that scheme. Hopefully it works out for you.
Yeah, yeah. Just maybe wait another 50 years or something. I don't know.
50, just 50.
Yeah, maybe not the best investment, but okay. So when you were in California, what kind of tech were you doing before you decided to starting invest in real estate?
I worked at SanDisk, which is they're a flash memory company. Always doing finance and financial modeling and analysis, and then worked at Electronic Arts. So yeah, right in the Silicon Valley, man. It's good times.
Okay, very
Yeah.
cool. All right. So if someone wanted to go to your website, they think this is a great idea. What's the typical kind of bread and butter property that people put on here to start renting out rooms?
Yeah, a lot of times some folks will come to us with the home they already have, and sometimes they'll buy with us. But if they're buying with us, we typically will say, we're going to look at each zip code, we're going to look at occupancy, and we're going to kind of help them find a 5 bedroom, 2, 3 bath, and we'll likely make that into we'll likely add a bedroom or two. It'll be compliant with, like, in terms of, there'll be like code, we'll be following code and how we build out those rooms, but that adds revenue that's really difficult to get in any other way, right? If you have more rooms, you make more money. So that's typically, and so people will end up with a 6 bedroom, a 7 bedroom. We recently started doing 8 bedrooms because we saw a couple of our competitors doing that. So those are kind of the houses which you have to set them up just right when you have that kind of density to ensure that everything's working in terms of the mechanicals and the plumbing and all that. So it's something we've become quite good at.
Okay. In California, the ADUs, accessory dwelling units, are really big. So do y'all ever get into
Mm.
stuff like that as well? I guess like building a detached external home or other stuff, or converting garages?
We do convert garages, definitely. Um, in terms of we ADUs, we that's not really our bread and butter because you end up like you have a you have like a roommate house, which is sort of like you got your 6 roommates in a house, and maybe one of them is living in a converted garage. And then and somebody living in an ADU would almost be a different type of tenant in which they have the whole space. And so they're and that could work. It's a bit muddy, right? When everyone's there to live in a communal way, then that means they get to share everything. Then it allows it to be more consistent in terms of the experience. And so having like a long-term family renting an ADU in the back with 6 roommate tenants, I think it would be challenging to say the least. So yeah,
Okay, just curious. So
yeah.
assume it depends on the market in terms of what each room would go for. But if I was like underwriting a house, I'm based in Dallas now, so let's say it's Dallas, and was doing like a 5 bedroom, what would I expect to rent out each of those? Maybe get six out of it or something.
Yeah. Uh 500, 550 probably for each room. Which sounds low, but we utilities aren't included in that number, and the tenants pay for utilities. So if you include, like, the tenants are each paying 750, but a lot of that just goes straight to utilities.
Oh, okay, got it. And then so they pay the utilities, and is it prorated based on square footage that they occupy?
Uh, it's not that complicated. It's just everyone just splits it based on number. It's based on number of days you're in the house, and then it's even across.
Oh, how do you determine how many number of days they're in the house?
Oh, we have the releases.
What do you
Oh
mean?
no, sorry. They're under a lease. We don't actually track people in and outside of the building. It's like
Oh,
you
okay,
pay for a fraction of the days that you have a lease with in the property.
got it. Yeah, it's not like just punching a clock and going, clocking in, clocking
You
out.
can't you can't you gotta utilities, you even slicing it the way we do it, which is just days under lease, is really complicated. To do anything more nuanced than that would be, oh man, that would be a crazy town. So we're this is as nuanced as we get, I think, for now. So
Okay, that makes sense. And it's always shared bathrooms and shared kitchen.
yep, exactly.
Okay, very cool. And you mentioned like buying with your company. Can you go into that some more? Just like looking at your website, and on the surface, it makes sense, like lease a room or list your home, but then there's like also invest in a property. We basically just like talk about that, how would or someone be able to invest with your company.
Yeah, most people we actually, most of the homes that come on through buying with us. We recommend that because we'll help you select the property, right? We have agents locally in each market, and um and those agents have been trained to find these homes, right? Identify homes that have the most, it's like you're looking basically lowest price per square foot and then like max rent per square foot, right? Like it's a unique formula that involves using our kind of data to forecast room pricing based on size and based on location. So we recommend people buy with us if they can, and then we'll identify a home for you. After we'll help you pick a market. We'll connect you with an agent. We'll help you get pre-approved for a loan to purchase the property, and then we'll do the underwriting on the property. Basically, give you an estimate of the rent we expect from it, as well as like the returns over a long period of time. So that's sort of how our purchase process works, and we'll do most everything, including like the construction to add bedrooms, as well as do furnishing the home and setting it up for a rent.
Okay, so do y'all have a Rolodex of your own contractors that y'all use?
Yeah, we have a number of partners within throughout all the cities and metros that we're in.
Okay. And then do y'all take any like equity share of the property, or is it just purely whatever fees y'all charge on your website?
Yeah, we don't take an equity share.
Okay. So I guess it's
Yeah.
just like a fee or something that's charged on each booking, or how does y'all's business model work? How do you make money in the whole scheme of things?
Yeah, we make money in a few ways. One is if someone's buying a home with us, we're going to make some money there. We'll make money from the construction of setting the property up, right? Because we're acting as a general contractor. We'll make some money if we refer you to one of our lenders. Well, actually, we don't get money for that. We have a partnership with our brokerage with the agents, so that we'll make money there. So it's upfront the purchase, and then as you have the property on our platform, we'll make 15% of rent. Co-living is a more complicated, more challenging model than standard single family rentals. So the percentage rent is higher, and the lease up fee we also have that, and that's just a bit higher as well. So across the industry, that's really the standard. Is that in standard rental single family homes, you're looking at like an 8% of rent, and you're looking at 1 month's rent for like your lease up. As you go up the food chain into co-living, it's higher, and then you go to short-term rentals, it's even higher. So management based on difficulty, the fees are higher, but usually your net will be substantially higher, even with these higher fee models, because you're usually adding value, which is what HomeRoom's doing.
Okay, and are any of your clients ever living in the houses as well to do some like house hacking?
Um, well, I did it, so I guess if I'm a client. I'm not doing it today, but yeah, I did it for a number of years. We definitely get asked that a lot. I don't know if we have any investors that are currently living in properties though today.
Okay, so for these hands-off investors, are they self-managing it remotely, or are they hiring a property manager, or the people just
Uh,
manage
we we
themselves?
we act as the property manager. We're the master tenant, but we're like the master tenant who also does maintenance and keeps the property in good shape.
Oh, okay, so you'll have some system for handling calls in the middle of the night for busted toilets and stuff like that. Kind of
Yeah,
landlord's nightmare.
yeah, we definitely do. Yeah.
Awesome. Okay. Very cool. And that's what's justifying the 15% of rent paid. It's like a property management fee, basically.
Yeah, it's a platform fee plus property management. That's correct.
Okay, cool. Yeah. Yeah, I use a property manager for two rent houses in Colleen, Texas, and we pay them 10%, which is kind of standard. So that makes sense. Maybe like the extra 5% is for the website booking fee or something, I guess. I don't know if that's how you actually look at the breakout, but that's how I would kind of imagine it.
Yeah, we don't really we kind of it's kind of all encompassing, but it covers, roommate mediation and things that are unique to co-living. Yeah. So we see short-term rental managers are charged 20-30%, right? And so we see co-living operators typically charge somewhere in the range of 20-30%. Short-term rentals is higher and standard rentals is lower. So each model has its own fee structure based on kind of the complexity of running that model. And so usually those models don't really, so you can't really compare a single family rental to a co-living home, even though they both are single family homes in terms of the price and the operations.
Okay. Yeah, that's helpful to understand the overall kind of universe and the hierarchy, like you said in there.
Yeah. Yeah, we hear the single family rental comparison a bit, and it's when you have multiple tenants, they're moving in and out at different times. You have managed services like cleaning and yard care, finding roommates is more difficult than finding single family rentals, pricing it. There's just a lot of pieces to the co-living universe that just don't exist in single family rentals. It's substantially more challenging, but it's also substantially more lucrative if you do it right.
Okay. So yeah, I was thinking if you had, say, 5 rooms and it's $500 each, it's 2,500 gross revenue, and then minus the 15% fee that's paid to you guys. I'm just trying to think what would be like the total gross income and what's kind of your NOI, your net operating income, and what's like the overall return that someone could expect to get. Do you have those just ballpark numbers?
Yeah, I mean, NOI is not, it's more of a commercial, or sorry, it's more of a multifamily number, more not not typically single family as much, but we're generally looking at, if we switch over to cash on cash, which is close, we're always looking for positive cash flow. And we generally are underwriting our stuff assuming loans, right? So our NOI and our cap rates between 2 and 8, I think, right now. But it's those are not um, numbers that we typically are discussing with our investors, because that's sort of a different world that uses those measurements.
Okay. So maybe like I guess 8% cap rate based on the NOI, which is before the debt service. We're getting really complicated here. You're going down the
Yeah,
rabbit hole here, but on cash, it's after debt service. And so would it be maybe, I guess, single digit below 10% on a cash on cash return?
yeah, our cash on cash return focus is positive, or just a little negative after assumptions for maintenance and any kind of like full cash on cash is fully baked, including everything typically. So we're looking to try to get into positive territory. In cities like Atlanta or Indianapolis, we're looking to get substantially positive.
Okay, cool. One of the last things I was thinking of, in case people aren't familiar with it, a lot of these startup terms like Y Combinator and things like that. Could you just talk about that? Like, what is that program and how it relates to your company?
Sure. Yeah. Yeah, it's definitely a different world, the startup ecosystem, compared to real estate investing. So it's just like NOI is not that familiar with folks that are in the single family rental space. Y Combinator is not either. um, so yeah, Y Combinator is a accelerator program. It's considered one of the best in the world. It got started in the late 2000s and funded companies like Instacart, Airbnb, um, Dropbox. So it's probably the most successful early stage investor of all time. Um, so it's pretty cool program. They put you through for about 10 weeks. I'll put you in front of angel investors and venture capitalists to get to invest in your company. So we went through that program in the spring of 2022, and then did a seed round and raised a few $1 million from VCs and angel investors throughout the world.
All right. Yeah, that's very interesting. So do you like apply to be accepted into the program or how's that work?
Yeah, you apply it and hope for the best. It's really difficult to get in. It's super hard. We tried more than once, and we finally got in this I believe the second time.
Okay, that's cool. And then do you have to like physically fly over to wherever the place is for the full 10 weeks or how's that work?
We No, we didn't, because it was early 2022, and that was the last batch that was fully remote. So they historically have been in person, and they're back to being in person. But during 2021, 2022 pandemic years, it was fully remote. So
Okay. Where would they hold it and where are they holding it now in person?
it's been in Menlo Park since the kind of the beginning.
Got it. Okay. Just
And
curious.
yeah, Sam Altman, the guy that ChatGPT, the guy that invented Chat, or not invented, the CEO of ChatGPT, is the former like Y Combinator CEO. So it's kind of like a lot of ties into the tech ecosystem go back to Y Combinator.
Okay, very interesting. So are y'all still currently raising capital, or what's that look like?
We're currently not raising capital. We're good for now, and the last time we raised was actually the spring of 2022, and hopefully that'll get us quite a ways, which we're excited about.
Okay, yeah, that's great. Just grow organically from there and all that. All right. Well, at the beginning of the episode here, I mentioned your website, which I'll put in the show notes, but is there anything else you want to hit on, or is there some contact information you want to leave for folks that want to get in touch with you to maybe invest or start the process?
Yeah, you can always email me if you're doing house hacking or renting by the room, Johnny at livehomeroom.com. Happy to talk to real estate investors or people doing house hacking or people interested in the ecosystem. It's pretty cool. It's pretty cool to be at the beginning of, the co-living industry, really. Like, it kind of started in 2018, and there's a lot of folks still around and growing, getting pretty big. So happy to answer any questions there for folks. You can also kind of take a look at our website at livehomeroom.com, and if you have a home you'd like to list in one of our metros, we'd love to talk to you. And if you're looking to invest in real estate and you'd like to get above single family home returns, then we'd love to talk to you as well. So that's my sales pitch.
All right, perfect. Well, I think this was definitely interesting. It's a unique business model, and I'm glad that you came on to educate everyone about it.
Thanks, man. Yeah, thanks for having me, Mason. Really appreciate it, and it's been fun talking to you.
Hey guys, I appreciate you taking the time to listen or watch this episode. As you might have noticed, we don't run ads, but what I would like you to do is just subscribe to our YouTube channel. That would help us out tremendously. You don't even have to leave a review, but if you do feel like you would gain a lot of value from this episode, feel free to share it with your friends and comment, like, subscribe, all that. But subscribing to YouTube would be what helps us the most. That's the only thing I ask. Thanks a lot. And if you do want to get in touch with me, feel free to email me at mason@scalablerei.com. Thanks a lot.